choose Unisys, which is UIS. Unisys is an interesting one because it was this Burroughs Corporation, according to Wikipedia, and then in 1986 they actually merged with Sperry. So this was in the Nifty 50, and it turned into a merge in 1986, which is why that's our starting year in this back test portfolio.
And those were hot companies back then. Burroughs,
oh yeah,
Sperry. I mean, they were the high tech of that age.
Yep. So I just added the labels. Now I have to add the actual asset. So I'm putting the stock ticker here. And I can display up to 3 different portfolios. So again, for simplicity's sake, I'm going to do 100% of each of these 3 stocks in one portfolio each. Of course, Portfolio Visualizer is its own tool. I'm just giving a very simple example. Feel free to learn more about it as you see fit. So I'm just going to double check my work here. $5,000 starting, 1986 to 2015, $5,000 per year, and against the Vanguard 500 index. My name's good. All right, so I'll hit Analyze Portfolios. And in the summary view, I can scroll down, and we have a graph here on the bottom. I'd like starting with pictures. Wanted to note here that this is a logarithmic scale, right? So it goes from 1,000 to 10,000, 100,000, etc. So these numbers are not as steep as they would be if it was on a dollar scale or a normal scale. So the orange line here is Xerox. No, I'm sorry, the orange line is Unisys. The red line is Xerox. The green line is the Vanguard benchmark. And the blue line is Coca-Cola. So at the very end of this, you can see the journeys, right? Coca-Cola actually beat the index over that 40-year period from 1986 to 2015, right? So if you bought 100% stocks in Coca-Cola, you did incredibly well. And I would say you got lucky. I'll move up here to the table, and you can see the final balances in the compound annual growth rate. So Coca-Cola in this instance, from starting in 1986 and then going up through 2015, had a 19.98% compound annual growth rate. And your $200,000 investment over those 40 years turned into 1.1 million, compared to the benchmark, which returned 778,000. I wanted to note, though, that Unisys, you put a $200,000 in, and your output was $38,000. And Xerox, unfortunately, you lost about $3,000 over that 40-year period.
Well, and also, if you look at the maximum drawdown, that's from peak to valley. Unisys lost 99.2% of its value at one point, if I understand that.
That's right.
And that Xerox lost 92%, Coke 50%, and the S&P 500 about 50%. So it is individual securities just are much more risky. And what the academics believe is the expected rate of return of any single large cap growth company is the average of all large cap growth companies. That's what the academics believe. Of course, everybody who owns those individual companies' shares believe they are worth a lot more than that. That's the nature of the optimistic investor.
And so I wanted to note the role of luck here. You can see the final balance on Coke is $1.1 million. I'm going to change the starting year and change nothing else, but I'll change the starting year to 1990. So you start 4 years later, and we end in 2020.
Oh, okay.
I'll hit Analyze again, and we'll scroll down to that table. And so instead of that nearly 20% compound annual growth rate, Coca-Cola returned a 17.5% compound annual growth rate during that period. And the Vanguard, the S&P 500, returned an 18.5 compound annual growth rate. And so in this scenario, if you started 5 years later for whatever reason, you would have done better with the index compared to Coca-Cola.
Yes. Thank you. I like that. That's a good example.
All right. So,
Ready for me to move on, or you got something more you want to?
well, we haven't talked about how this leads to millions of dollars.
Okay. What's your view?
So my view is that, you know, definitely compared to picking a loser, you're well ahead, right? So compared to picking Unisys, we have, multiple 300,000 multiples of $300,000. So in this second example, where I started in 1990, Unisys returned $100,000 for our investment, and the Vanguard index, if we were in the index, returned $900,000. So you're looking at $3 million or more because you chose the index over the one of the companies that didn't do so well.
And what again the academics will tell us is that when you own one company, you have the possibility of completely going broke, and that you can protect against that only by having a whole bunch of companies, and maybe it isn't one versus 1,000, but in fact, they will say, the academics will say, it's one versus 100. That at 100 you have plenty of protection, but that you're not getting any premium. You don't have an expected extra amount of return because you own one company. And a quote that I actually made years ago was, you should never make an investment that you don't have an expected premium over the long term. Now, nobody ever uses my quote, but I remember it. Okay, on to what I tried to start before, which is one of my favorites, and that is paying high expenses or paying low expenses or paying no expenses. That's a possibility these days. What do you got for us there? How can you make the claim for the $1 million difference?
Great. So Paul, I actually wanted to ask you some of the expenses to look out for. So an expense isn't just the fund's expense ratio, right? There are many more things that you could be charged for.
Yeah, get your checkbook out, because here they come. There's a load to buy a mutual fund if you buy a loaded fund, but it's only 5%, of course, and it is for the professional help of an advisor who's acting theoretically in your best interest. And so instead of suggesting that you invest in an index fund with no load, they recommend a load fund. And so there is a 5% right off the top. Guess what that translates into in the annual return of an equity fund? About 0.5%. And then there are the expenses that you talk about in the mutual fund, but that does not include the turnover expenses in a mutual fund. Those are the costs of buying and selling. And the cost of buying and selling an actively managed fund internally is not just commissions. It's also the spread between the bid and the ask every time that they want to buy or sell. And when you're talking about big mutual funds, when they want to get out of a position, they're likely having to put pressure on the market and force the price down rather than forcing the price up when they're trying to buy. So there are a lot of real kind of subtle hidden costs. And then there's taxes from the turnover. I mean, there's the cost of the turnover I mentioned, but that turnover is going to be an expense that leads typically to a tax cost. And believe it or not, when you look at the S&P 500, and Morningstar tracks this with individual mutual funds, it can be a 1 to 1.5% tax a year tax advantage to the index investor for somebody who's holding these in a taxable account. Well, boy, you start adding all those things up, and I don't know how much to deduct from the returns that a fund might make once you have all of those expenses. And maybe I've even overlooked an expense or two. I'm not sure, but that's the majority of them. And what do you do with that information then, Craig?
Right. So that all turns into a percentage of your portfolio, right? So if you can cut if you can cut your expenses, that's a guaranteed return on top of what you were already getting.
That's right. And so how do we convert that into $1 million?
Yep. So I know you've been focusing on an extra 0.5% over a 40-year period. And so what we're going to do in the calculator is we're going to change the historical returns by 0.5% to show you how that has an impact on the investment over this 40-year period.
Let me make sure I understand that. So if I look at the S&P 500 and I know that it returned over the average 40-year period, it returned 11%. And so what we're going to do then is look at the return for the people who made less than that percent. Is that what we're, because it's not a matter of adding to the index, it's a matter of deducting from the index to get an idea of how much more you're making. Is that, in essence, isn't that the way it works?
Yep. So instead of a positive number, we're going to put a negative 0.5% in there, and we'll see what the outcome is.
Yeah. So
simulating the idea that they paid 0.5% in fees to be in that S&P 500. So I'm at our standard.
Wait a minute. Wait a minute. I want the truth here on the table. It is the average expense ratio in funds in the category of the S&P 500 is close to 90 basis points, almost 1%. So really, I'm saying if we're going to put this to the test, let's look at, oh, you're thinking about the 0.5% as the magic apple. All right. Go ahead. I'm sorry.
Well, let's say it costs you 40 basis points instead of 90 basis points to be in the S&P 500. Then you save in a particular fund, then you've saved your 0.5%.
All right. There we go.
So I'm in our standard scenario again, 40-year duration, $5,000 per year for 40 years of accumulation. The bottom number in the S&P 500 in 100% stocks is $2.6 million. All right, that's without these expenses taken out. We have a field here called change historical return, and you can put any value between negative 100% and a positive 100% in there to simulate, I guess, a different return. And it just takes that value off of whatever the return is that year. So I'm going to put a negative 0.5%. And that $2.6 million turns into 2.289. So there's your $300,000 right there over a 40-year period by saving an extra 0.5%.
And the reality is that the difference, and I guess we're going to talk about index versus active, but that 0.5% is that's the bottom. I mean, we got to do better than a 0.5% for people to feel like they've paid the right price for that free PDF. But here it is right there. There's that $1 million from that 0.5%. That's great.
Well, there you have it. Steps 1 through 5. We're talking millions. Thank you for tuning in. We will continue with part 2 next week. I should note that you can download the free PDF of We're Talking Millions and access the lifetime investment calculator right now on our website, paulmerriman.com. See you next week.